All right, welcome everybody. Another episode of Whiteboard Wednesdays here. Geoff Thomas representing Invest, and the topic today is going to be life insurance. Now, you can make this as complex as you want, but I think it always comes down to two main things when it comes to life insurance. What type and how much? Those are always the main questions that are asked when it comes to insurance. But like I said, I want to make this very simple, right? So let's just do a simple T-chart. And let's compare the two. We have term insurance and we have permanent. Now, what makes up permanent? A lot of different categories. You have whole life policies, you have L65s, L10s, you have universal life, you have index universal life. But today, to keep this very simple, I'm just going to compare and contrast with a term and a basic whole life policy. So let's start with the term. As it says, term is just that. You're going to have a fixed death benefit for a certain period of time, right? But we don't know what life throws at us. We may get an illness. We may have no knowledge of when we're going to pass away, right? So over time, this has a fixed cost, right? The moment you implement it, you're going to pay the same premium over time. But what I find is a lot of people view this as an expense. Now, the industry tells us that 98% of term policies never pay out. Why? Either we outlive them, or we view it as an expense. We may have a job change, we may have a divorce, and the question always comes up, do I need to keep this? So again, a lot of people use it and think of it mentally as an expense. But what term has is a low price. But over time, it's gonna have a higher cost. Because as you age, you're gonna be underwritten differently. You know, over time, you may have something that came about from a health perspective, right? So we have a fixed cost initially for that term, but if we ever had to renew it, our cost is likely to go up because our age is continuing to go up. So let's just talk about a traditional whole life policy. You have three branches that grow simultaneously. You have a death benefit. You have what is known as a cash value that grows within it. Most common is a 3% guaranteed, but if you deal with mutual companies, you also have a dividend, right? This also has a fixed cost when you start. But over time, if you have these things growing simultaneously, you can view this as an asset on your balance sheet. Because what we know is that, look, it's gonna have a higher price to start. But over time, it's gonna have a lower cost. Because having these multiple dimensions gives you optionality of choice. Maybe the dividend could cover the premium. Maybe it'll be paid up at certain points. So again, this can be utilized as an asset on your balance sheet. And I will tell you that when I talk with young professionals, retirees, business owners, sometimes term is the answer. Sometimes permanent is the answer. Sometimes it's a mix of both. We at Invest, we believe in protection, but we're agnostic to this. So when we have this conversation with our clients, we want to give them multiple paths that they can take where you can understand the economics, what the benefits are, both short-term and long-term, and so we can ascertain what type and how much and what that means to you. Again, we believe in protection. We think you should have it. But again, we're agnostic to that conversation and want to do what's best for the client at that time and meet them where they're at. So that's just a brief, simplistic compare and contrast with life insurance. Hope you enjoyed this one. If you want to reach out to us, have a further conversation, please follow us on the socials or DM me, whatever it may be. I'm Geoff Thomas, Invest. I'll see you on the next one.